Retirees can plan on 4 recessions during the standard 25 to 30-year retirement. I thought it would be helpful to make a video on this subject, answering questions like, what are your odds of bad timing when you retire? What is the likelihood that you may encounter a market crash or a recession at the beginning of your retirement? And what can you do about it? So I'm going to divide this presentation up into 2 parts. In the first section, we're going to go over a history of recessions so that you can see how frequently they occur and what to expect if there is a recession or a market crash. Then we're going to explore how to deal with it, how to protect your retirement from a recession. Let's start with a high-level view of your odds of making and losing money in the stock market. This is the last century plus that we're looking at of data. And what I've done here is I've built a table to show you what happens on any given year if you invest on January 1, 1 year later, 3 years later, 5 years later, and 10 years later, assuming that you've done total return and reinvested your dividends. In any given year, you have 74% odds of being positive at the end of the year. Tremendous odds of making money in the stock market. The flip side of that is, in any given year, you can finish the year 26% odds being negative. If you hold for 3 years, you're now at 85% odds of making money, 15% odds of losing money. Here's your recessionary risk. Your typical recession is going to be right here. 15% odds in any given year. 5-year hold, 88% odds of being positive after 5 years, 12% odds of being negative. And for a decade-long hold, this is going to be 96% odds of making money, only 4% odds that you will have truly bad timing and be negative on your stock investments 10 years later. It's really unlikely to happen, but it can happen. Another way to think about the 4% bad timing odds is to compare it to retiring in the year 2000 or 1928-29, something like that. That is what caused this 4%. Those are the only periods where you were negative 10 years later after investing in the stock market. So the likelihood that your timing will be truly unlucky and 10 years later you're still losing money is very, very low. But there is an extremely high likelihood that you will go through a long-term bear market similar to the 30s, the 70s, or the early 2000s. Let's take a look. Here's a look at the Dow Jones Industrial Average from 1896 to 2010. And don't worry, we're going to look at the S&P 500 next all the way through 2024. Why I like to show this to people is to demonstrate the fact that bear markets happen with an alarming degree of regularity. There's a very easy to identify pattern in the stock market. The green lines, which are bull markets, eventually end and give way to the flat red lines, which are bear markets. Boom, bust, boom, bust. The cycle keeps repeating. About every 10 years or so, the cycle flips. So a couple things I'd like to point out real quick. One, bear markets tend to be longer on average than bull markets. If you study this chart, you can see that if we add up the bear markets, they're longer in duration than bull markets. And bear markets are periods where you have no return for a decade or longer, typically no return on price whatsoever. It's a painful time period. So you should plan for your retirement that you will absolutely see at least one and maybe two bear markets during your retirement, and you need to be prepared for that. The same staircase pattern is exhibited in the S&P 500. Boom, bust, boom, bust. Here we are at the end of 2024, and we are late stage bull market. It is extremely likely that you are going to see a long-term protracted bear market in your retirement. We might not be that far away. Here's what a bear market looks like up close. March of 2000 to April 2013. 13 years, no appreciation on the S&P 500. Your odds of retiring right here before a 10-year slide are 4%, very low. But your odds of living through something like this at some point in your retirement and being impacted by it are very high. The two drops during this bear market of 49% and 56% were very hard on retirees. So it is important that your retirement plan takes into account that something like this is likely to happen, and you need to have an investment strategy and a distribution strategy that can get you through it. The period of the 70s was very similar to the first decade of the 2000s. 14 years, no appreciation on the S&P 500. Two very serious drops, and not one, not two, not three, but four recessions along the way. We very well may see something like this in the years ahead. We have had 15 total recessions since 1929. 14 out of the 15 recessions have had a loss. The average loss is 31%. One recession, 1945, that was right after World War II, we were up 19%. Anything can happen with a recession. You can see a wide divergence of returns from minus 89 to plus 19. But the typical recession, you're going to see about a 31% loss. 2/3 of recessions have a drop of 20% or more in the S&P 500. 93% of the time you can expect a loss if we get a recession. We've had 15 recessions in 95 years. We get a recession about every 6 years on average. The 15% odds where you retire and 3 years later you're still losing money in the stock market, that is consistent with retiring at the beginning of a recession. We have had 14 sell-offs of 20% or more since 1929. Most people call this a bear market. I call it a mini bear market. If you think back to the chart that I showed you earlier, a bear market to me is a period of a decade or longer where there's no return on price, with recessions along the way. But the common definition of a bear market is a 20% loss in the stock market. So there have been 14. The average is minus 38%, and they last 18 months on average. If your financial advisor isn't helping you plan for the likelihood of a recession in your retirement, please give my office a call. We would be happy to give you a second opinion on your retirement plan. Now let's talk about steps you can take to protect yourself from recessions and losses during your retirement. In my opinion, there are 3 things that you can do to protect yourself from recessions and market losses during your retirement. Number 1, you need a spending strategy that is sustainable. If you're withdrawing too much off of your portfolio, especially during periods of downturns and market volatility, you can run out of money. Number 2, you need an asset allocation that is also sustainable through market volatility and coordinated with your spending plan. And number 3, you need to have the right styles of investment in your portfolio when the market cycle shifts. Let's take a look at all 3. Here's what happens if we use a decent investment strategy but have an unsustainable spending plan. We're looking at an illustration for $1 million investment in the Vanguard Balanced Index Fund, made on January 1 of the year 2000. The Vanguard Balanced Index Fund is a 60-40 asset allocation fund commonly used by retirees. If we spend 5%, $50,000 in the first year, and then grow that distribution by 3% for inflation every single year, by the year 2023, we're out of money. I like this illustration because it shows what happens if we had not only bad timing, but several recessions along the way and some sequence of returns risk from the 2000 to 2003 period where we had several negative years. This illustration is for the same fund. Everything's the same except for one thing. We've adjusted our spending plan. We're now spending 4% in the first year, $40,000, and growing that by 3% for inflation. Tremendous difference over 25 years. We have $825,000 as of November 30, 2024. So by having a spending plan that's sustainable, you don't have to worry about running out of money in retirement. You are protected. And you were able to survive, as this illustration shows, sequence of returns risk, bad timing, and 2 recessions along the way. A lot of volatility in '08 and '00 to '03. The only negative here is that after 25 years, you have less money than you started with in retirement. And for some people, that might not be acceptable. You might need to have a lower spending strategy, maybe 3% or 3.5% versus 4%. The takeaway from the illustration is that a 4% spending rate in retirement is sustainable. It survives a worst case scenario. A 5% spending rate in retirement is not sustainable. If you have bad timing and you plan to spend 5% during retirement, you could run out of money. Asset allocation is the second variable that you need to think about when planning your retirement. Here's what happens if you have the wrong asset allocation when you retire and have bad timing. If you retired on January 1 of the year 2000 with $1 million in the S&P 500, and you used a sustainable withdrawal rate of 4%, your spending strategy is $40,000 in the first year and then grow that by 3% for inflation every year thereafter, 2022, you're out of money. If your asset allocation is too aggressive in retirement, like having all your money in the S&P 500, you may not make it through a long-term bear market. Here's a look at what has worked and not worked during past bear markets with recessions. We are comparing growth investing to value investing. If we had put $100,000 on January 1 of the year 2000 in the Russell 1000 growth index and the Russell 1000 value index, this chart shows us where we would be by October of 2011 on a total return basis for both indexes. In the growth index, we would be down to 76,000, over a decade of losing money on a total return basis. In the value index, we would be up to 137,000. So we made money during a protracted bear market with not one but 2 recessions. Something you want to take note of as you're planning your retirement. You want to be shifting investments from growth over to value to protect yourself if we do get a protracted bear market. During the same period, small cap stocks provided positive total return when large cap stocks failed. We're looking at the S&P 500, the orange line, versus the Russell 2000, the purple line, from January 1 of 2000 to November of 2011. If you had put $10,000 in the S&P 500 on January 1 of 2000, by November 22nd of 2011, you still had $10,000. And this is total return. The Russell 2000 was 16,000 plus. That means you had a 60% total return over this time period in small cap stocks versus the S&P 500. So, as part of your retirement strategy, you do want to have some amount of small cap stocks in your retirement plan. The question becomes how much of your portfolio should be in small caps, especially in retirement. It's going to be a small percentage. Most retirees just can't handle the extra volatility that comes with small caps. But I think that some amount of small caps, even if it's a small percentage, in your retirement portfolio is a good idea. So let's add it all up. Recessions happen about every 6 years. Your odds of retiring with a recession on the doorstep are 15%. Your odds of retiring into the teeth of a long-term bear market that lasts 10 years or longer are very low, only about 4%. But you can be sure that during the course of your retirement, you are very likely to see a long-term bear market at some point, and you will probably see about 4 total recessions and a lot of volatility along the way. The way you protect yourself from recessions is to have a spending plan that is sustainable. Most financial planners would agree that 4% is a sustainable spending rate. 5%, now you're getting into trouble. You want to have an asset allocation that makes sense and can handle volatility, is paired with your spending strategy, but also is aligned with your risk tolerance. Value stocks and small caps both provided positive returns in the last protracted bear market. You should consider having a tilt in your portfolio towards value stocks, and you may want to consider an allocation to small caps. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.